For decades, selling a house meant sitting across the desk from someone who lived in your zip code. It was a highly localized ecosystem of independent brokers, appraisers, and inspectors piecing together a transaction. But that local system is notoriously slow. You list the property, wait for an offer, and then sit through 30 to 45 days of inspections, appraisals, and underwriting. Along the way, title companies, escrow officers, and agents carve out their individual percentages, leaking value out of the deal at every step. Institutional investors recognized those friction points and built a centralized machine to eliminate them, engineering a closed loop where one corporate entity owns every touchpoint. This flowchart maps out exactly how that consolidated ecosystem operates, from the initial targeted marketing down to the final mortgage. It is designed to capture a property and move it through a precise internal assembly line. We are looking at the financialization of the neighborhood. The local service economy is being replaced by a highly capitalized Wall Street manufacturing pipeline. The standard method of entering the housing market involves sticking a sign in the front yard and waiting for a qualified buyer to drive by. Look at the left side of this diagram. Institutional firms replace that passive sign with active AGI-assisted influencers. These AI models scrape personal data, search histories, and financial distress indicators. They identify homeowners dealing with divorce, job loss, or medical debt, and deploy highly targeted marketing directly to those specific sellers before the house ever hits the public market. Once a vulnerable seller is engaged, the system relies on the massive capital at the top of the chain, a $100 million warehouse line. This is a short-term institutional credit facility provided by major investment banks. That war chest allows the firm to bypass traditional mortgage wait times entirely. They deploy that capital as an immediate cash purchase, closing in days rather than months. For a family in financial distress, a 7-day cash close provides vital, instant liquidity. However, the models systematically calculate the lowest possible acceptable offer, stripping equity away from sellers who lack the leverage to negotiate. In modern property acquisition, victory goes to whoever combines the sharpest data targeting with the fastest deployment of capital. Once the deed is signed, the property does not return to the open market. It moves deeper into the corporate ecosystem for renovation. Moving to the right side of our flowchart, the home is assigned to an affiliated licensed general contractor. Notice how the funding flows internally, completely avoiding the need for external bank loans. By centralizing the supply chain, the firm orders materials in bulk and sequences labor with factory-like efficiency. It drives down costs, but it also imposes a generic, standardized aesthetic on the housing supply, while starving independent local contractors of work. After a rapid cosmetic update, the home is finally presented to a retail buyer. But the firm isn't done. The network actively steers that buyer away from independent lenders, funneling them directly into its own in-network mortgage broker. This animated bar chart shows why that final step is crucial. The single column represents the profit margin of a traditional house flip. The two-color columns shows the institutional model. They capture the margin on the home sale, and then they capture thousands of dollars in mortgage origination fees and interest over time. This model extracts wealth by positioning the network as the gatekeeper for every financial choke point in the property's lifecycle. Historically, buyers and sellers hired agents to guide them through an unpredictable, open terrain. Today, engaging with one of these firms means stepping directly onto a closed manufacturing conveyor belt. Operating in this landscape requires a defensive strategy. First, investigate the true identity of the buyer. Look past the generic LLC name on the offer to see if they are acting as a proxy for a massive institutional warehouse line. Second, calculate the true cost of convenience. An instant cash offer might solve an immediate problem, but you must weigh that speed against the steep discount applied to the property's actual market value. Finally, protect your margins by actively unbundling their services. Even if you purchase an institutionally flipped home, shop outside their network for a mortgage broker to avoid inflated captive rates. By isolating the seller, supplying the contractor, and acting as the lender, a single institutional network captures the compounded profit of the local housing lifecycle.